Hi, good afternoon, everybody. My name is 𝗬𝗰𝘀. I head the fixed income team in Manulife Singapore. So before I begin, I'd like to thank all of you for taking time off your precious weekend to attend this event, and also like to thank FSM for giving Manulife the opportunity to present to all of you. So before I begin, I'd like to share with you something interesting that I think something that I think all of you will pretty much resonate well with. So during the December holidays, when I was catching up with friends and relatives, they all commented, hey Alvin, you know that fixed deposit rates are quite attractive. You're getting like 3 to 3.5% in Sing dollars. So why do I want to be invested in bonds? I mean, it is a very valid question, very valid statement. But the thing is that we are at the turn of the interest rate cycle. The global central banks, they have been aggressively tightening policy. They have been aggressively hiking interest rates, and it's the most aggressive rate hikes we have seen in decades over the past 2 years. But that has an impact on global growth. Inflation that has peaked last year is starting to come down significantly. And they are worried about potential recessionary risks. They are worried about significant slowdown in growth. So many of the global central banks are actually turning from a more tightening policy to a more accommodative policy. So for example, at the recent FOMC or the Fed meeting in December a few weeks ago, the Fed has somewhat pivoted. So they have increased their forecast of dot plots from 2 cuts this year to 3 cuts. So the thing is that when your fixed deposits, when they mature in 3 months, 6 months, or 1 year's time, the attractive rates that you're getting today is not going to be the same as what's going to happen when it matures in 3 or 6 months or 1 year's time. So what can we do to capture the opportunities when central banks start to cut rates and when yields start to move lower? The answer is actually bonds, and we can actually find it in Asian bonds. So for today's presentation, I'm going to talk about the income seeker's guide to Asian bonds. So for today, I'm going to split the presentation in 3 parts. Firstly, I'm going to touch on the Asia and Singapore bond market outlook. Then I'll touch on our 2 funds, our Manulife Asia Pacific Investment Grade Bond Fund, and then our Sing Dollar Income Fund, where you can capture opportunities in both Asia bonds and Sing Dollar bonds. And then I'll touch on our investment strategy for the year. Now, I think last year, I think all of you probably would know it's a really challenging year and volatile year for markets. We have seen quite a few things that happened. For example, we have seen escalating geopolitical tensions in the Middle East. We have seen ongoing conflicts between Russia and Ukraine. We have seen aggressive rate hikes by global central banks, the most aggressive we have seen in decades. We have seen that having an impact on the financial system. So we have seen bank runs in the US. We have also seen a major Swiss central bank, bank going belly under. And lastly, I think closer to home, I think for China, I think that has disappointed markets. Growth has disappointed expectations. And we have seen headline risks coming out from the China property sector. And this has really weighed on overall market sentiment. But that said, there is a silver lining over here. We think that what has been headwinds last year, we think it's going to be turning to strong tailwinds for this year. So 3 themes that really matters for Asian fixed income and why it's going to support this asset class. Firstly, we think that the Fed is already at the end of its tightening cycle. We think that the next move would be rate cuts, whether it's going to be 2, 3, 4, whatever the case. Over the medium to long term, we think that yields are going to trend lower from these levels. Secondly, besides the Fed, we think that other major global central banks as well, for example, the Bank of England, the ECB, they are all going to be looking to cut rates. There's a huge concern that the economies in those regions might enter the recession. So they are concerned about growth, and they are looking to potentially cut rates this year. And what it means that the overall environment for interest rates is going to be accommodative, and that's going to be supportive for Asian bonds. And for Asia, yes, we do understand that global growth is going to slow down, but Asia is still going to be the one bright spot within the global economy. Growth in Asia is still going to be stronger compared to other developed markets and emerging markets. And lastly, for China, we have seen strong signals from the government. They have been implementing expansionary fiscal policies as well as accommodative monetary policies by cutting their interest rates. And they have also targeted measures to support the property sector. So overall, we think that sentiment over there would improve, and that's going to bode well for Asia bonds in general. Over here shows the global central bank's policy rates, and what we have seen is that over the past couple of years, as I mentioned earlier, really aggressive rate hikes by global central banks. But that said, we are at a turning point for the interest rate cycle. Global central banks are looking to start being concerned that growth is going to slow down significantly. Inflation has already moderated from the peak. So the next step is actually global central banks to start cutting rates. This chart shows the global GDP expectations. As I mentioned earlier, we expect global growth to moderate, so from 3% last year to probably south of 3% this year. Asia continues to be the one bright spot within the global economy. It's still going to be growing at a much faster pace compared to other EM and DM markets. This chart shows Asia central bank policy, current policy rates versus historical rates. And what we can see right here is that Asian central banks' policy rates have a lot of room to cut rates further if necessary. And inflation in Asia has actually been benign, quite relatively well behaved. So, Asian central banks have definitely room to support the economy, to cut rates further if necessary. And this would actually bode well and support Asian bonds. So some countries where we see opportunities. So for China, as I mentioned earlier, we are seeing strong signals in China. They are targeting more expansionary fiscal policies as well as more accommodative monetary policies by continuing to cut their interest rates. They are also targeting the property sector by introducing more measures. So I think for China, that's it. We don't expect GDP growth to be high single digits. They are moving towards more domestic consumption driven. So GDP growth is still going to come in still healthily at more than 4%. We like China onshore bonds. We think that the PBOC cutting rates would be supportive for China bonds. In addition, many investors have actually been underweight China over the past couple of years, given the headline risk that's coming out. We think that there is the positive. We think there's going to be strong technicals as investors will start to put their money back into China again. So that is on the local currency. For hard currency, so hard currency actually means Chinese issuers, Chinese corporates issuing in US dollars. So where we like the strong state-owned enterprises. So many of these companies, they have strong strategic relationships to the government. So they do provide a stable income as well as they have very strong fundamentals. And then within the high yield sector, we do like some of the crossover China property names. Yes, they have been badly beaten down, but we do see some dislocations. Some of the better quality property names are actually trading at very attractive levels. But I think it's really important to highlight that it's important to do proper due diligence on these credit names and to identify names that can ride through this cycle. Another country that we like is Indonesia. It continues to have a strong structural fundamental story. We think that growth for this year will come in above 5%. It has very favorable demographics, a very young population. Indonesia has benefited from the strong FDI flows, given that the surge in commodity demand. So for the likes of coal and nickel, that has seen an uptick in demand. We do like the local Indonesian government bonds. So, the curve generally is trading above 6.5%, so it really looks really attractive. In terms of foreign investors, they have currently it's about 15%. So foreign government ownership is actually relatively low compared to historical average. It used to be as high as 40%. So we think that once this flow start to come back into Indonesia government bonds, that will be very supportive. We think that the Bank of Indonesia is also unlikely to hike rates again. They did that last year to kind of manage the currency volatility, but the currency has stabilized. So actually we think that the Bank of Indonesia, I think the next step is actually for them to look to cut rates, and this will be supportive for Indonesian government bonds. In terms of the hard currency wise, so on the dollar side, we do like the Indonesian quasi-sovereign bonds. Those bonds do provide an attractive spread pickup compared to the Indonesian US dollar sovereign curve. The next country that we also like is South Korea. We like the Korean won, and that's really on the back of the macro fundamental story. Since October last year, we have seen a rebound in exports, and that's really on the back of the semiconductors as well as AI-related products. So typically in a broad dollar weakness environment, which is our view for this year, the Korean won will actually be a strong outperformer within the Asian region. Within the Asian dollar space, the hard currency space, we do like the AA to BBB investment grade credits. Last year, Korea was the second largest issuer within the Asian dollar bond space. So many of them, they did come in with decent concessions as well as attractive yields, attractive coupon and income. So these are names that we do like in Korea. Next up, closer to home, and that's Singapore. So this chart shows the MAS or the Sing dollar near. So typically for global central banks, when they manage monetary policy, they manage policy by increasing rates or cutting rates. But for Singapore, we are a very open economy, so the way we manage monetary policy is actually by managing the currency. So for example, when inflation is going higher, in order to manage inflation, what the central bank does is to tighten policy by appreciating the Sing dollar near. So for this year, we think that growth for Singapore is going to slow down. As I mentioned, we are a very open economy. We are susceptible to external factors. We think that growth for this year will come in at the bottom range of 1 to 3%. That said, if growth were to slow down significantly, the government has significant fiscal reserves to help support the economy. Just to highlight, Singapore's sovereign rating, it is rated AAA by all 3 external rating agencies. So we are the only one in 9 countries that has this AAA rated rating. Within Asia, we are the only one in Asia with this gold standard. So what it means is that many of the high quality corporates that issue in Singapore, they have direct or indirect links to the sovereign. So this really underpins their stability in addition to their solid credit fundamentals. So we do really like the high quality Singapore issuers issued in Sing dollars, as they do provide a very stable income for the portfolio. Now this chart shows the movement of US and Singapore 10-year Treasury yields. As you can see in this chart, both of them move pretty much in tandem with each other. Our view is that US Treasury yields will start to trend lower and to end the year lower for this year. And this is similar for Singapore government bond yields as well. As such, we think that Singapore government bond yields will also trend lower towards the end of the year. This chart shows Asian investment grade credits in US dollars versus US investment grade credits. So on the left, what we can see is that over the past 10 years, Asian dollar bonds, investment grade bonds, have actually performed better and also performed with a much lower volatility. So what it means is that Asian dollar investment grade bonds, they do provide more attractive risk-adjusted returns compared to their US counterparts. So relative valuation-wise, and in terms of performance, we do think that Asian investment grade credits do offer compelling valuations. So for our next section, I'll touch on our 2 funds, our Manulife Asia Pacific Investment Grade Bond Fund and our Sing Dollar Income Fund, where we can find opportunities to be invested in Asian bonds and Sing Dollar bonds. So before I go on to the fund specifics itself, we have won quite a number of awards for both our funds, so we are really recognized for excellence in fixed income. And also, we have also won awards for the Asian fixed income team as well, outside of our awards. So for the first fund, our Manulife Asia Pacific Investment Grade Bond Fund, it is a very high quality investment grade portfolio. It is low volatility, looking to provide a stable source of income. We are looking to capture opportunities across credits, rates, and FX. For credits, we have probably one of the biggest credit research team within the Asian region. We have about 20 credit analysts covering more than 500 over Asian issuers. So we really look to focus on the high quality corporates and banks, issuers that are able to ride through the different market cycles. We also look to take advantage of the local market, so we can take up to 20% in Asian local rates and FX to really add value to the portfolio. In terms of duration, the portfolio is able to take duration from 1 to 5 years. Currently, the portfolio's duration is at the upper end of the range, really to take advantage of the move in lower yields going forward. Lastly, this fund is CPF approved, so you can it's something that you can use your CPF money to invest in, and we are targeting a 4% payout and distributed monthly. So this slide shows a snapshot of our Asia Pacific Investment Grade Bond Fund. So really you can see that it's a very diversified portfolio across both hard and local currencies in Asia. The next fund we would like to present is our Manulife Sing Dollar Income Fund. So this fund is really targeted at investors who hold Sing dollars, investors who want a regular income stream from Sing dollars, investors who wants to be invested in Asian bonds, but with a focus on Singapore. So for this fund, a minimum of 30% has to be invested in Sing dollar denominated bonds, and these are mainly high quality bonds. As I mentioned earlier, we do like the high quality Sing bonds as they provide stable source of income, and Singapore is rated AAA by all rating agencies, so that really underpins this issuer's stability. In terms of the other 70%, or the rest of the portfolio is invested in Asian dollar bonds, and all the US dollar currency is actually hedged back into Sing dollar. So this fund does not take any active FX risk. In terms of credit quality, it's also average investment grade with the potential to take up to 30% in high yield. Duration-wise, we manage duration actively from 0 to 5 years. We have managed duration from as low as 2 3/4 years all the way up to 4.5 years. Currently, we are at the higher end of our duration range, similar to the previous fund, where we look to take advantage of the move in lower yields. And then lastly, we look to target a 4.5% annualized payout. So this slide shows the snapshot of our Sing Dollar Income Fund. As mentioned earlier, it's really focused, for investors who wants to be invested in Asian bonds, but with a focus on Singapore. So you look at the bottom left, not surprisingly, Singapore is a large contributor in terms of country exposure. So just to sum it up for investment strategy, just to highlight again, we think that the headwinds from last year would turn into strong tailwinds for this year. Some key things to highlight: we think that global central banks have moved from a tightening policy, and now they are moving to a more accommodative policy. They are looking to cut rates, and that would be supportive for Asian bonds. Inflation in Asia is also relatively well behaved, and the demand technicals for Asia is going to be positive for this year as well. We also think that selective exposure in Asian local rates and FX would also add value to an investment portfolio. So just to sum it up, we advise investors to think about, to have a core position in Asian US dollar and Sing dollar bonds. And we think our two funds, our Manulife Asia Pacific Investment Grade Bond Fund and Sing Dollar Income Fund, is well positioned to do that. It provides attractive yields, a stable source of income, and Asian bonds have also shown to provide strong risk-adjusted returns over the medium to long term. So with that, I end my presentation, and thank you for being around. Thanks.